In this video, I want to show you how to calculate basis for S corporation stock. We'll start with a shareholder's initial basis before making a series of upward and downward adjustments, which I shall show you momentarily, to arrive at the shareholder's new basis in the S corporation stock. Now, you're going to notice a couple of things when I show you those adjustments. First, the main things that increase a shareholder's basis are going to be the shareholder's pro rata share of any income items, as well as any capital contributions made by the shareholder to the S corporation. Okay, so those things are going to increase the shareholder's basis. Now, the things that are going to decrease the shareholder's basis are going to be the shareholder's pro rata share of any deductions or losses, and any distributions that are made by the S corporation to that shareholder. Okay, so we'll discuss those specifics in a minute, but first I want to notice a key difference between S corps and partnerships as it pertains to basis. Okay, when it comes to S corps, company borrowings, and by company borrowings I mean if the S corp were to go out and borrow $2 million from Bank of America, company borrowings have no effect on the shareholder's basis. Okay, the only exception is if the shareholder themselves, okay, so let's say we have a shareholder named Susie. Susie goes and loans money to the S corporation. Okay, so if the shareholder loans money to the S corporation, then the shareholder will actually have a loan basis, and we'll keep track of the stock basis and then the loan basis, and the loan basis can come into play if the stock basis goes to zero, and then there's a loss with the S corporation. The shareholder's trying to deduct it. They can actually apply it against their loan basis. Okay, we'll get into that. I'll even make a separate video on that. But the key takeaway is that if the company just goes out and borrows money from some bank, okay, so it's not borrowing money from the shareholder, they're borrowing money from some bank, that increase in a company's borrowings is not going to affect the shareholder's basis, okay? And that is not the case with partnerships. Partnership, the company that borrows money, that'll increase the basis of the partners, right? Their basis and the partnership interest. But that's not the case with S corporation. Okay, why? Because if the company goes out and borrows $2 million from Bank of America and it doesn't pay, okay, the shareholders, that's not their responsibility. That's the responsibility of the corporation. Okay, so that's just a difference between S corp and partnership. Now, let's get into those specific adjustments I was talking to you about initially. Well, I said that you start with the initial basis, okay, the shareholder's initial basis, and I said you had a series of upward. Okay, so here we've got a bunch of pluses. So here's our upward adjustments to the shareholder's basis, and then we have some downward adjustments, some things that will decrease the shareholder's basis. Okay, so I'm going to go through these. The initial basis, okay, what they start out with when the shareholder initially gets a stock, that basis depends on how the shareholder got that stock. Okay, if the shareholder bought the stock, let's say they just paid cash, they just paid $10,000 cash, then that would be their initial basis in the stock. Okay, but what if they didn't buy the stock? What if they inherited it? Okay, if they inherited the stock, then they would get a stepped up basis. Okay, so it depends on how they got the stock. If they got the stock as a gift, then it'd be a different basis and so forth. Okay, so you got their initial basis that they start out with, and then we're going to make all these potential adjustments. Okay, now all these are going to apply to every situation, but if the shareholder made a capital contribution, so if they contributed capital to the S corp, okay, additional capital. I'm saying, like, initially they put in 10 grand, they got the stock, but then later they put in more into the S corporation. Any capital contribution is going to increase their basis, okay? Basis is important for a number of reasons, but one is, basis allows you to take deductions for your share of the S corp's losses. So if you are like, oh, I need to increase basis so I can deduct some losses from an S corp that's losing money, one way is to contribute more capital to the S corp, okay? Now, so capital contributions increase the shareholder's basis, but also pro rata share of the ordinary income. When I say ordinary income here, I'm talking about non-separately stated income, because remember with the S corp, they actually have separately stated items, things like long-term capital gains. Okay, so we've got separately stated income, ordinary income, pro rata share of, so we got this is basically non-separately stated income is ordinary income. Okay, in case I don't want anybody to be confused. So pro rata share of any non-separately stated income, pro rata share of any separately stated income, even the pro rata share of any tax-exempt income is going to increase the basis of that shareholder. Okay, now, and it's going to, when I say pro rata, I mean if the shareholder owns 35% of the company, okay, so they own 35% of the shares, then they're going to get 35% of any separately stated income items, 35% of any tax-exempt income. That's what I mean when I say pro rata, okay? Now, any depletion, okay, this has to do with natural resources, so a lot of companies, this won't apply to them, but any depletion in excess of a property's basis, except, so we're not talking about depletion for oil and gas, okay, so non-oil and gas depletion in excess of a property's basis, that will be added to the initial basis in determining the new basis for the shareholder. Now, in terms of downward adjustments to basis, things are going to decrease basis. Any distributions that were not reported as income, okay? So if we just have a standard situation, shareholder has some basis, it was never a C corporation, there's a distribution made to the shareholder, it's not in excess of their basis or anything like that. It's just standard distribution to the shareholder. It's not reported as income. That is going to decrease their basis, okay? Now, non-deductible expenses, and we're talking about fines and penalties here. Things that are, we're not talking about capital expenditures. Capital expenditures are also non-deductible, but that's a different story. We're not talking about capital expenditures. So non-deductible, non-capital expenses like fines and penalties, those will also decrease the shareholder's basis. The pro rata share of any ordinary loss, and again, when I say ordinary, I'm talking about non-separately stated, and also pro rata share of any separately stated loss and deductions. So for example, if there were short-term capital losses, okay, that would be separately stated item. So they would get, a shareholder would get a pro rata share of that. If they own 35% of the S Corp, they get 35% of the short-term capital losses. And then also decreasing the shareholder's basis, depletion deductions for oil and gas that do not exceed the property's basis. So we make all these adjustments. And like I said, most situations, some of these things, like some companies won't have any depletion, so you don't even have to worry about that. They might not have tax-exempt income. And you get to the shareholder's new basis. Now, note, the basis can never go below zero, okay? It can't be negative. So, and again, as I said before, you need basis. Basis is one of the things that you need to be able to deduct losses. The only way you could deduct loss with an S Corp if you don't have stock basis is, again, if the shareholder were to loan money to the S Corp, right? Then if they had no stock basis left, they could, and the S Corp had a loss and they had a share of that, they could first, or they could, even though the stock had no basis, they could apply that against the loan basis. Okay, if the shareholder made a loan to the S corporation. Okay, and like I said, I'll try and make another video on that. Now, so basis can't go negative. Any losses that don't get used can be suspended, and like I said, I'll make another video on that. But also, another limitation, other limitations to think about in terms of deductibility of losses. Obviously, we think about you need basis to be able to deduct a loss, but also the Section 465 at-risk rules, the passive loss rules under Section 469, also Section 461, the excess business loss rules. So we've got all those hurdles as well when we're thinking about the deductibility of losses. Now, let's get into an example here of how we would go about calculating the basis. Let's say we have a shareholder named Marcus who owns 25% of an S corporation. How we would go about calculating Marcus's new basis, assuming a number of things happen. So to make it easy, let's assume that this S corporation has never operated as a C corporation, so they don't have any accumulated earnings and profits from old days when they were a C corp. Okay, just to make it simple. Marcus, so he owns 25% of the S corp, and his initial basis is $50,000. So we know that's what we're going to start with when we do our formula, right? We're going to start with that $50,000. That's our starting point. But during the year, okay, the S corporation had $40,000 tax-exempt income, and you know he's going to get 25% of that, right? That's pro rata, okay? It has $60,000 long-term capital gain. You know he's going to get 25% of that. And then it had an ordinary loss, non-separately stated loss, okay? 25% of that, $10,000. So we see the items here. I've got the adjustments. Tax-exempt income, okay? Income items, your pro rata share, so 25% of $40,000, which is $10,000. That's going to increase his basis, right, by $10,000. His pro rata share of the long-term capital gain, that's a non-separately stated income item. 25% of $60,000, $15,000. It's an income item, so it's going to increase the basis. Basis is going to go up. Now, we also got Marcus receiving a $30,000 cash distribution. That is going to reduce his basis, okay? So we're going to reduce the basis by $30,000, and then we've got the share of the ordinary loss, 25% of the $10,000 loss. So we're going to have a $2,500 decrease in the basis for that. Now you see 50,000 plus 10,000 plus 15,000 minus 30 minus 2,500. We end up with a new basis of $42,500. Now you might be wondering, hey, how did you choose the order in which to do these? Like you might notice I did the income items first, and then I did the distribution, and then I did the share of the loss, right? That is not, I didn't just pick that randomly. Okay, so there's actually an order of basis adjustments. First, what you're going to do is increase the basis by pro rata share of any income items, any excess depletion. We didn't have excess depletion in this situation, but we did have 2 income items. Okay, so that's why I had those first. And then you're going to decrease it by any distributions, right? That's why I did the distributions next. Decrease it by any non-deductible, non-capital expenses. We did not have any of those here in this situation, so we didn't have to worry about that. And then decrease the basis by any pro rata share deductions and losses. That's why I had that last. Okay, so the losses go last. So basically, we start with the basis, then we do the pro rata share of any income items, then we deal with the distributions if there were any, then we would deal with any non-deductible expenses, didn't have it here, and then last we do the pro rata share of any deductions or losses. We end up with the new basis for the shareholder, $42,500.